What is up, everybody? We are live. It's Monday. That means the markets are back open after the weekend. Typically on Mondays on Wall Street in New York, they say, hey, you know what? It's been a few days, Saturday, Sunday. It's time we open this thing back up. And they did. And you know what? Things are actually pretty quiet today. We got some data this morning. The Empire, the New York manufacturing, and that was not good, and some China numbers that were not good. So a lot of people were, thinking today could be a bloodbath, a red day. We're not really seeing that. We've got some headlines, like the title of the show says. We had some advertising news out of Apple, some more apps coming to your iPhone. If you're like me, you got an iPhone. Potentially Apple said, Tim Cook, Apple's CEO, said some more ads coming to your apps on your phone, like the Maps app, Books app, Podcast app, potentially. So, I'm actually surprised not to see Apple up more on that, because if you think about it, everyone has an iPhone. So they put one ad, they add one ad on the Maps app on the iPhone that goes out to, 50 million people or however many. Like, it seems like that'd be a nice little money maker for Apple. So we shall see. But, some other headlines throughout the day we will go through. As always, let me know in the chat what stocks you guys are watching. Looks like Super Spackman's looking at SBSW. I believe that's Smith & Wesson. Oh, no, it is not. Which one's Smith & Wesson? SBSW is Sibane Stillwater. I'm not familiar with this one. Anyway, quick rundown for the show today. Here in a few minutes, joining me will be Jake Wujastyk from TrendSpider. So we run through some charts with Jake. And then at around 12:15 p.m. Eastern, NewsByNick. Nicholas Brown will join us to talk about what he's been watching as well. So go ahead and smash the like, subscribe to the channel if you have not already. Without further ado, let's go ahead, roll the intro, and bring Jake on.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujastyk from TrendSpider. We have
breaking news. All right, Mr. Jake, how's it going?
Doing well. How are you?
Pretty good. How was your weekend?
It was good. It was pretty quiet. My son's not feeling great, so that's always fun to deal with. But yeah, overall good weekend. Finally, hopefully getting to some fall weather soon in Denver, so can't complain.
Oh man, well, hope Cuba starts feeling better. And yeah, I mean, we started getting, I'm not gonna say fall yet, but we started getting, up here in Michigan, like at night over the weekend, it was like, man, I could use a little jacket or some pants, for the first time. So that was nice.
Yeah, no, we're slowly getting there here as well. So, but yeah, no, everything's good. Nice to kind of see the market holding on. I personally think we're in a kind of a cycle in the market where so many people are just getting wrecked trying to short this market, that it's going to be really hard for the market to drop even with this bad news. I remember back in 2015 when I was just really, really, really heavily short the market into 2016. And, I'd wake up every morning looking for bad news. And that's just at least in my opinion, just a really crappy way to go about trying to participate in the markets. And, you saw it today, bad data everywhere, but that doesn't matter. The market doesn't care about that. It cares about how much of this was already priced in. Over the last 6 months, the market priced in a lot of bad news. It almost priced in a recession already. And I think the market wants a recession. The market's looking for bad data, because that means that the Fed may not raise rates as quickly. I think, at this point, the Fed raising rates is simply just a function of inflation. So the Fed is a little tied there where they can't necessarily just slow down raising rates if prices are continuing up, because the last thing you want is a slowing economy and increasing prices increasing. So I just think we're at a point where you just have a lot of people who just made some good money on the way down from January to July, and then the market stopped going down, and people just continue to add to these short positions, which is just giving more fuel to the fire. And I think it's, I think it's a lot of retail, but I think it's also bigger money too. And a lot of people just forget that the market is a discounting mechanism, right? It started discounting a lot of this stuff months ago, and that's why you're seeing a disconnect between this bad data coming out now and the market not really reacting at all. So from like a chart perspective, you can see here. I'm sharing my screen, right?
Yep. We've got the S&P 500 pulled up.
Yep. Yeah, you can see that we're in this rising wedge, ascending wedge, whatever you want to call it, which is simply just kind of when price, the lows and the highs are slowly starting to kind of get closer and closer. That's what creates this wedge. And a lot of the time, this can be a bearish setup. If we're looking at kind of the statistics on generally how an ascending wedge plays out, you more than often get a move to the downside. However, it's not always the case. There's no setup in the market that is just guaranteed to form, and then all of a sudden you've got a move down or a move up. So this is one of those things where we're still in the ascending wedge at this point. The apex is essentially just the end of this setup, and we're just slowly creeping up kind of right towards the apex. Now, if you look at a different perspective on the daily chart, this is kind of getting back into the volume by price, something that I've used a lot on the show. And this is something that this is really just kind of why it's hard for me to see the market moving down, at least over the next couple of weeks. You're just entering this area, this area that I have highlighted as a volume gap. It just shows pretty much since the March 29th high here, these volume bars on the right-hand side are just measuring where has volume occurred. You can see here, there isn't any price gaps where I have this orange area highlighted. It's not a price gap, it's a volume gap. It's an area where there's not a lot of volume that has occurred. So there's not a lot of shares that are getting back to break even, right? So when we're moving up from the June and July lows, you could see that this area right here, right? So imagine that you bought the SPY here, the 411, 412 area. Well, these shares here, these volume bars represent, shares that bought at this level. So when you're way down here at 364, 380, this, as you move up, this area, and it kind of did a textbook consolidation here where we had to get through a lot of these shares. These shares just went from a drawdown of, these shares had a drawdown of up to 13%. So as the price starts moving back to this area, these shares are slowly getting back to break even. So this is why I like to call it break even supply. It's an area where people, held on to their shares. They're back to break even. They're like, wow, that sucked. I'm getting out. That adds supply onto the market. And that's why generally you have trouble getting through these zones at first, because you have a lot of supply that the market needs to digest. Maybe somebody just completely gets out of their whole position. Maybe somebody takes half off the table, whatever, it's adding supply onto the market. But here you can see we don't have that. Pretty much up until like the 440s, you don't have any shares here that have even really participated in the market, because you had this big candle here. So you can see here, if we just move this to the left, this candle here, this was a sharp drop. So there wasn't a lot of volume that even had time to aggregate in this area. And that's why it's essentially acting as a gap in liquidity. So, it wouldn't shock me to just see the market continuing to melt up through this area just because there's not a lot of supply above. And these kind of volume shelves act as a magnet. So, kind of generally speaking, we could probably just grind up towards the lower part of the shelf here, 437, 438, all the way up to like the mid 440s. Especially if we can close, the market's about to go green right now. If we can close above this previous high from Friday, it's hard for me to see the market pulling back. We just went green. So, I really personally just don't care where the market goes. I think a lot of people do because they're too heavy in their positions, especially on the short side. So you're just seeing a lot of people frustrated. It's like, well, the manufacturing index, China data, this is ridiculous. Why aren't we dropping? It's not dropping because there's so many people that are short, and there's so many people that are just stuck right now with their pants, around their ankles, just absolutely just getting annihilated here. So, until those market participants kind of capitulate, meaning that they cover their shorts or whatever, I just think we're going to slowly continue to grind up. And, I'm happy to be wrong if we don't, but that's just kind of the logic and the thesis and on why I think, we could continue up, especially where you don't have a lot of liquidity above. And if you look at breadth, you have a lot of sectors kind of rotating, right? So it's not just Apple, it's not just Microsoft moving the market up. You've got AMD, you've got Nvidia starting to look pretty good. You've got Tesla. So, you do have other names participating in the markets now, which is kind of allowing the market to continue to grind higher. Apple has a bad day or a good day, it's not going to affect the whole market because you have other parts of the market starting to kind of fire off as well. One of those, which isn't really going to move the market much as far as the S&P goes or anything, but weed stocks are really starting to move now. You've kind of got money rotating into growth names that have gotten destroyed. So there's just a point right now in the market that I think it's really hard for the market to drop simply just because there's so many people trying to short it.
Yeah, and I was talking about that last week and how, like I saw so many people on Twitter and Reddit and whatnot that were like mad, when the market was up and we got good news last week and stuff, and it was just like, I mean, I get it, right? Like if you want to be short, if you think we're overextended here or whatever, but it seems like to me, like you said, people are just getting caught and then they're doubling down on it. And I saw, even after we've come up now almost like 20% off the lows, the short interest on the S&P is at its highest point in the last like 2 years. It wasn't, months ago. It was people are now waiting and they've seen, okay, we're up 20%, thinking we can't keep going higher. I'm going to short it. When we always say the trend is your friend, so it's like now that we've reversed and we've been in an uptrend, people don't seem to want to believe it. And I'm not quite sure why.
Ego, pretty much for the most part. I think people just are they want to be right so bad, and they want to whatever. And I can say that because I've been there before, right? I've had
right. Me too.
So it's just ego, people that they want to be right, and then all of a sudden they're not right, and then they're like, they start revenge trading. They're like, oh, well, I'm going to short it anyways. And I mean, you brought up a good point. Go look at 2 years ago when short interest was at the highest it was back in the summer of 2020. What did the market do into the end of August? It literally went straight up, and then we had a pretty strong correction in September. But I mean, it's crazy, and we'll go back to that. Look at this. This is
yeah, I think it was toward the end of summer was the last time, the end of summer 2022. So maybe July, August was the last time short interest was this high.
Yeah, and look what happened from mid-June to the late August. You literally went straight up. This is a classic example of a melt up, and I think we're in a melt up right now. Does that mean that I think long to medium term, we're fully out of the window of possibly going lower? No, but I'm also not here denying what's happening in front of us, which is price action showing that the market wants higher. A melt up is simply just a few things. It's people that are FOMOing into the market, but it's also people essentially having to buy back, their shares that they shorted, which creates artificial demand in the market. So, I would not be shocked if into the end of August we just continue to move up like this, like we saw in 2020, even if we're having bad news. So
yeah, and then you're gonna get more people coming in and saying, "Oh no, we got to keep going. We got to go down now," and then short it. Keep adding to it. So I don't know. Yeah, I mean, to me, I just love it's like the law of physics, or something in motion will stay in motion. The trend is your friend, right? Why fight it?
Yep. I mean, look at you start pulling up the moving averages. 50 days starting to curl up. 20-day just crossed the 50-day here. I mean, look at the last time the 20 crossed the 50. You had a pretty sustained move down. So now it's the opposite's happening. We've got a pretty sustained move up. 200 days still declining, so that's something to consider, and that's probably going to be a psychological level for the market to have to get through, which is right around 431, 432. But I just think that this reminds me a lot of the summer of 2020, and exactly why, right? All this bad news is coming out. People are shorting, wondering why it's not working, and a lot of people forget. The stock market is not the economy. The stock market discounts a lot of this stuff about the economy way before this stuff happens. And people are wondering, why does the market keep going up? Well, that's just how the market works. So yeah, I'm happy to change my thesis. As I mentioned, back in August of 2020, we melted up and had a huge move down. So I'm not over here saying we couldn't have a big move to the downside, but you're likely going to get a big move to the downside once all of these short positions capitulated. And then all of them turn long, and that's when it generally will reverse. So for now, we're just looking at liquidity here. There's no liquidity above. We can move very quickly through this volume gap to the mid 430s easily, without any good news. At this point, I think the market needs to have some really random bad news that it hasn't discounted in yet, and it will have to have a completely far out of left field data coming out that the market hasn't even considered for there to really be a big move to the downside. Even at that point, you still may have so many people short that it's going to be hard for the market to drop. So, we're almost up 0.2% now in the market after we've talked the last 10 minutes. So it's just kind of proving to people that we don't have to have good news for the market to keep going up.
Yeah, and what I would say to people out there that for whatever reason really want to be short, and what I don't really understand with it is you can always try to find companies or whatnot that you don't think are positioned well or may not survive if the economy does take a downturn. But when you're shorting the overall market, you're shorting, it's just never worked historically. The S&P 500 has always come back. If you look at Apple's chart right now, I mean, Apple, I think, is S&P's biggest weighting. Is Apple's chart is ridiculous how much it's. Oh, I think I just accidentally hit something. Music.
1 second. I think my Spotify just started playing. No.
No, I think I might have done it on my end.
I don't know what that was. Can you hear me?
Some sort of music. Yeah, I can hear you.
That's weird.
But yeah, Apple's chart. Oh, now we're getting an echo. All right, I think we're good now. Apple's charts, we're almost back to all-time highs on Apple. I wouldn't want to be short Apple. I wouldn't want to be short the S&P 500. If you want to be a bear, if you want to be short, go out there and find some companies, that aren't going to recover, that aren't even in the S&P 500.
Yeah, I mean, that's kind of what I've been looking at is look at the laggards, right? If the market's moving up, look at what's lagging. That's why I became bullish on wheat stocks, into the weekend, because you have a lot of these bases forming here. Like ACB is one that I actually got in last week. I finally started to kind of get back in the markets and trade a little bit, simply because my son's now daycare and I have some extra time to do that, which is nice. It's always nice to look at the markets and analyze them, as a completely non-biased participant. But it is nice to get back in the seat and start trading again. So yeah, this is one I took 172, and same thing. There's no supply above. I mean, literally. If you're just using the volume by price, there are really no shares up here that are back to break even, which is what creates that supply and resistance zone. So you do have a pretty big gap from 228 all the way that fills 254. So that's one. I think CGC's up even more, or was up more today. It's up 12%. So yeah, I mean, wheat stocks are definitely starting to reverse here. If you look at the monthly candle and you kind of anchor the volume by price from the 2015 lows, you've got a lot of shares holding here, and that creates kind of a base for price. And that's That's why we may have a green month for twice out of the last like 15 months here, right, or more. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
Yeah, we haven't talked about like the pot stocks doing well in a long time.
Yeah, and who knows? Maybe this is just another little squeeze, but I mean, we really haven't closed and broken above the previous month's high like we have now in pretty much literally like 2 years, so, or a year and a half. So this may be a little bit of a status quo changer here. And I mean, just look, every time that we were dropping here, pretty much since 2021, you weren't breaking above the previous month's high. You just kept hitting these new lower highs. Here was one back in November of 2021 where you did have a candle that broke, but look, it still closed way below. So, we still have half a month. So it's tough to just look at the monthly candle and do too much analysis on something that still has a half of the time period to play out. I.e., it's a monthly candle. It's the 15th of August. We still have half the month. So this could completely look like a different candle by the end of the month. But yeah, this is, the weed names look good. I mean, I don't know what, yeah, NVIDIA. I mean, NVIDIA is potentially about to break out here. You've got,
yeah, I did see someone in the chat was talking about AMD as well. So I assume AMD is looking pretty similar to NVIDIA today.
Yeah, AMD was kind of one that I was looking at as a trade idea. Posted some trade ideas on my personal account yesterday, and pretty simple thesis, right? So you look at the price action since the low here, and you can see there's a lot of volume supporting price, and we're breaking Friday's high. So I don't know. I think semiconductors are probably going to kind of take the lead here over the next week or two, and that could just slowly grind the market higher too. So yeah, huge volume shelf here. Targets are simply just pivots, right? So this is your previous high on August 4th, so 104 to 104.50, and then your next high over here. Look to the left from June is in the 109 to 109.50 area. So I think this one could be a pretty strong one going into this week, and yeah, it's just hard for me to be too bearish here. Unfortunately, maybe for some people that are bearish, but I think it's just watching price action. There's just a lot of really strong setups right now, and a lot of really strong setups would have to fail for the market to really dump here. Disney's another one. Disney's just gone pretty much straight up since the bottom here in mid-July. So it just feels like there was a lot of negative stuff priced into the market. We're kind of starting to correct to the upside. So yeah, Disney's been a really strong one.
Yeah, and I don't know if you saw the news today that Steve Loeb from Third Point Capital, they're getting in at making an investment into Disney. So I do think, I was even looking at Disney before the company reported earnings, and then they reported pretty strong earnings, and that got me even more interested. Like at first I was like, oh shoot, I missed out on a few percentage points there, but now I'm like, hey, you know what, it's still well off its highs. I think Disney long term, but I don't know why, I mean, if I'm going to hold it for 10, 20 years, I don't know why I wouldn't.
Yeah, I mean, and look, same thought process that we were just talking about on SPY. Look at, there's no volume here. There's really not a lot of volume that has occurred here since the high in September of 2021, which is just kind of your pivot here before the next leg down. I mean, it's just supply and demand. There's not a lot of liquidity here. That's why we've been able to just go straight up from from August 10th. I mean, it's up over 10% since in 4 or 5 days. And a lot of that has to do with just not a lot of supply above. Now then, notice here, you've got 2 previous lows here from January and March. You just highlight those, and where do those kind of cross paths with? The next area of supply above. So, it wouldn't shock me to see this maybe cool off in the low 130s, 132, 133, but And until then, it looks pretty strong to just continue up.
What about another chart that I was actually looking at over the weekend that I couldn't really, I didn't really come away from it after looking at it thinking, bearish, bullish. I was just like, huh, that's interesting. Was Bank of America kind of right where we were at pre-COVID levels? We've certainly bounced off the lows, but it's not really shown any relative strength. I don't really know what financials are doing in general. I think they probably all look similar to Bank of America's chart. Um, but it's just like, I don't know. It's weird to be like, I would just assume Bank of America or at least and JP Morgan, that the biggest banks are making money. I mean, you would hope, right? They're banks. That's what they're supposed to do.
Yeah, I mean, this was really just kind of a pull back to where the trend is. I mean, you do a little bit of that, create this zone, and it's really just kind of bouncing off kind of the zone that you'd expect. So, this, for those that are like interested in how I create these zones, right? Like, I don't want just one data point, right? What does that mean? It means, okay, we started from the 2011 low. I connected it to this wick, extended it. There's 2 points. That's not a lot of data. However, you can see that, there's points that are relatively close to this line, a little higher. So what I do is I just kind of will increase it till we get to this area. Now, instead of just 2 data points, we've got this data point here. We've got multiple candles here that held this area. We once again are bouncing right at the low or the upper part of that zone. So these zones just create a more relevant area to watch. And, I'd say Bank of America looks pretty good. I mean, banks do better when rates are higher. So, Bank of America looks pretty good here.
Yeah, I mean, and that's why I think I was looking at it too, because I was thinking, okay, well, if rates are going to keep raising or keep rising at the pace that we have so far set forth, then maybe adding some bank exposure is fine. And I mean, I use Bank of America. I like the company. Like they're fine by me. They're one of the companies that I use on probably a daily basis when I use my debit or credit card, and I'm pretty happy with them. So I'm like, hey, maybe I should look at their stock. And I think it pays a dividend. I think most financial stocks do. But yeah, I mean, it was almost worrisome a little bit to see it at its pre-COVID levels, just because I feel like most stocks, I think we're still well above our pre-COVID levels in terms of the S&P. So like the stocks that are doing really well are obviously above those levels. But Bank of America, I mean, to get it down there at 30, what's that right now? $38 or something?
It's at 36 right now.
36. Yeah, I mean, I don't hate it, especially for more of an investment, less of a trade.
Yeah, I mean, from the highs, it drew down 40%. So,
Jeez.
I mean, that's a pretty big drawdown. I mean, you're creating a nice base here. You've got a kind of a rounded bottom. Just, I really do honestly think the market priced in some really, really bad things happening. And we can see that they are happening. But they were already, when I say they are happening, manufacturing index was absolutely horrible. But the market already priced that in. It was already priced in. So when it finally happens, if it's already priced in, the market's not going to drop. It's likely going to move up, and that's kind of what we're seeing here. So yeah, all in all, just a lot of charts showing pretty strong bases forming. A lot of these names, these growth names, already down 80 to 90%. They can't keep dropping. Pretty much the end of the world was priced into them. So, at this point, a lot of these names, your PayPal's, your Roku's, they're the ones that topped out way before the market did. Roku was like the poster child of like the whole COVID rally, and now all of a sudden, it's down 90, 80 something percent. Let's see. From the very highs to the actual low, down 87%. I mean, and when did this top out? This topped out in July of 2021. That was like 4 or 5 months before the markets topped out.
Yeah.
So I can see some of these growth names starting to form a base and possibly kind of signaling, maybe we're bottoming out, similar how they topped out before the market peaked. So Roku price action is kind of weird, but honestly not a horrible chart. PayPal, another one that was kind of the poster child of the COVID rally, starting to look decent here. I think, if we can get above like 105, this thing could move pretty quickly to the 120s, 130s, kind of similar to what Disney's doing. So just hard for me to see the bear thesis. And the thing is, I just am not that exposed to the market. I'm trading it and all that, but it's not something that like I have an emotional connection to. Like a lot of these people, I think, have really put a lot of their money into shorting the market, and it's showing. Twitter sentiment. I mentioned I thought the market was going to have a pretty big rally in July, and like just some of the comments, some of the retweets are just like added to my thesis that we're probably going to go up.
Yeah, no, that
so mad, and I'm like,
right.
Opinion.
That's where I'm at too, because people like last week, who was it? It was someone. It's his Twitter account. It has like 30,000 followers. It's like Thunderdome Capital or something. And it was after the jobs report came out. I guess this was maybe 2 weeks ago on that Friday, and they were like, or no. It was when the CPI number came out. So the CPI was lower than expected. The market was ripping, and he was like, "Guys, recessions are deflationary. This is bad news. Like, don't worry. Like, thesis still on short." And it's like, how, like, you have to realize how warped like your bias is right now, because you get objectively good news, the market is up, and you're saying no, the market's wrong, I'm right, whatever. And it's just like, come on, like we've been dealing with inflation for a year and a half. Can't we celebrate a little bit that prices finally came down month over month for the first time in a while? Gas prices came down $1. Like, that's good news. That's objectively good news, but to some people, I guess it's not.
Well, yeah, and like in his thesis, or whoever, you were just the Thunderbolt guy, and recessions are deflationary. That's why the market's happy about this bad news, because that means that the economy and like the recession, we're either probably in one or getting close. The market and now is saying, let nature kind of run its course. We don't need the Fed to continue to raise rates. We now have this recession that's going to lower prices naturally due to a lack of demand. The market wants that. The market moves on interest rates, and so many people don't realize that. It's just where, the market, initially, you saw bonds going up during all this bad news over the last 6 to 9 months. And so what happens is money can then flow from this risk-on market, i.e. the equity market, into the bond market, which is a lot more just safe haven. You can get a fixed return on your money. So you get think of a billionaire, right? Someone that's got $1 billion. If they can just go put their money in a T-bill, pretty much risk-free at 3%, they're going to take that money and take that interest rate for a while the market kind of figures itself out. And, if prices start dropping, then the Fed doesn't need to intervene like they have been. And then people go back to risk on. This market is just priced in a lot. And as I mentioned before, you're going to have something that comes out of complete left field. Maybe it's some huge liquidity crisis in like the financial markets again. But that's the kind of thing that I don't think is priced in yet. Now, if there's some crazy liquidity crisis that comes out of China or whatever, then that's new information that the market has to digest. But a lot of this information coming out now is news that the market already knew, and the market is hoping for a recession so the Fed can back off on these hikes. And just I think a lot of people just need to go back to macroeconomics and just read a book on macroeconomics. The market cares about interest rates, nothing else. And I think that's
I agree 100%. I think right now it's like you said, that we would need some unforeseen negative catalyst to come in, because it's like, can we go down? Like, think about it. All right, so we were just down when we were at market lows in mid-June. And even maybe a little bit before that. Every headline coming out was, as bad as you can get, right? China was completely shut down with COVID, right? Inflation was highest it's been and growing. You know, certain things from companies, you know, where you're getting bad guidance from Target, Walmart, everything looked terrible. And then over the last 2 months or so, you know, some of those headlines have started to get a tiny bit better. And I could see a pullback, right? We've been up basically straight up 20% from the low. So if we pulled back, you know, 5% off that 20% that we've gained, I wouldn't be shocked at all. Is this Apple pulled up right here?
Yeah, this is Apple, and I was just going to say, you know, generally, if you have a move like this in Apple, you're going to get some type of pullback.
Right. So I foresee that, like, to people who are short or bears out there right now, to that credit, I could definitely foresee a pullback, especially in these names like Apple that have virtually just gone up 20-30% straight up. But to go back and retest those lows, like I still see on Twitter and Reddit right now, people are saying, oh, to everyone who thinks the bottom was already in or we've seen the bottom. To go back and retest those lows in June, we would need, like we had in June, some of those really, really bad headlines that weren't there, whether it was China being completely shut down, whether it's companies, you know, guiding down or whatever. We would need, like you said, Jake, some unforeseen things that hasn't been priced in yet to get us back to that levels. Doesn't mean we can't have a little pullback from here. I mean, I could foresee a nice little healthy pullback.
Yeah, it'd be welcomed, honestly. I mean, you look at Apple, we're at this like descent. This is a descending, broadening wedge, right? You know, the highs are lower, the lows are lower, but it's broadening. That's why it's called descending, broadening wedge. This makes sense where we'd have a little bit of a pullback, but I don't foresee this type of move going and doing this. I just think this is like a buy the dip type of I think the pullbacks at this point are buy the dip. Happy to be wrong, but I'm just speaking just from like what the market is showing me. Apple, SPY, I mean, they're all at this broadening wedge resistance, and I don't know why my annotation isn't popping up, but I mean, I could just draw it real quick. You know, same thing here. We're nearing, you know, a longer term resistance zone. So it makes technical sense why we'd have a pullback. I'm just not thinking we're going to have the next crash again.
No, I agree. I think we're seeing pretty eye to eye there.
So this is something like if you want to kind of like create a constant in your analysis, this is how you can identify leaders and laggards, right? So here's the market, all-time highs back in January, create a resistance zone, okay? So this is all-time highs in January. Now go to the Qs. Draw the same line, right? This is the same zone here. And this is probably bears are not going to be happy about this. Draw the same zone here, all-time highs in November. This is your resistance zone. What's happening right now? We're breaking out. So now we know the S&P is your laggard because it hasn't broken out of this resistance zone yet. The Qs are definitely leading the SPY, but now go look at IWM. IWM, let's get rid of all these VWAPs. IWM has been leading this market forever. Same thing. You draw your resistance zone from the all-time highs. We broke out on IWM 3 weeks ago. So IWM is clearly your leader. So at that point, start looking at IWM as maybe something that's going to foretell when we do get a pullback. Meaning, you know, if the S&P 500 and the Qs are up, but IWM is down 0.5 or 0.8%, that may, you know, use the leaders and the laggards as a tool to get an idea of when we may get a pullback. You know, and IWM today is definitely lagging the Qs and SPY. It's only up about 0.04%, but it's still looking pretty good. You know, I have a target on the IWM to like 209 to 212 before we get any type of like meaningful pullback. You know, I had somebody mention like yesterday or something on my Twitter, like the S&P 500 is up 4 weeks in a row. It's got to pull back soon. All right. Well, pull up the pattern recognition feature on TrendSpider. Type in, I think the highest we can go is 6 green candles. Type in 6 green candles, and the system's automatically going to look for anytime there's been 6 green candles. All right. Well, we had 6 green candles during December of 2020, and we continued to go straight up. You go on the S&P 500 and you type in 6 green candles, and generally, you know, it's not a bottom. A lot of the time, it can be a little bit of a top, but just looking solely at how many times, how many green candles there are isn't going to do too much. Here's a chart of just looking at volume. This is another one that people have you know, been talking a lot about. Oh, we're moving up on low volume. Yeah, well, I mean, look at all the really major bottoms since 2009, 2010. Most of the time, you have capitulation and then you have decreasing volume. The one thing, you know, that I'll agree with people who are talking about, you know, this chart, you didn't really have capitulation volume yet. You didn't have a big spike in red volume. So that's definitely something to consider. Like a lot of these other times, you have these huge spikes, which these volume spikes don't happen on the way up. They happen during capitulation events at the bottoms. And so, you know, that's why volume generally is decreasing after these capitulation events, because the volume is so big during the bottom that, you know, it's going to be really hard to match that volume as you grind higher and bottom out. So I guess my point is we don't have to have really strong volume for the market to keep going up. You simply need supply drying up and demand remaining constant, and that will actually so if supply is drying up, that's volume, and demand is remaining constant, that's volume. That means that the total amount of volume is declining because supply is declining. So that's just kind of something I'll point out is that's why I really don't have volume on my charts unless it's volume by price. I don't care about volume. I care about what price is doing. So
yeah, that's what I've always. Sorry, go ahead.
Oh no, I was done.
I was just gonna say for me, for volume, like I've always thought it was more important, like I guess the divergences within the volume, like for example, if you're looking at the S&P 500, whether if it's 10,000 shares traded, but it's you know exactly even versus half those shares traded, but 75% of those were people trying to buy. You know, it's like I understand for every trade there's a buyer and a seller, but for you know, for me, it seems like it's more important what that volume or what type of volume it is, I guess I should say, rather than just like a lot or a little.
Yeah, yeah.
Because volume spikes up when stocks are going up really fast and going down really fast, right?
Well, generally, if stocks are going up really quickly and you have a spike in volume, that's your short capitulation. That's all your short participants getting destroyed and having to buy the stock back and creating this artificial demand spike. So generally at the tops, you will see a spike at the top, you know, as the market's topping out, you'll see a big spike. And then at the bottom, you'll see a big spike in volume. And then, you know, as it's trending, you don't have to have some crazy volume. So the fact that the Qs are breaking out right now on the weekly chart, it's only Monday, so we have 4 days left, but definitely keep this in mind. But just really hard for me to see the market pull back here. What I'd expect to see is something like this on the Qs, where you kind of move up and then you maybe even retest that area and then continue to move up. That's just your classic SR flip, previous resistance, axis support. So we'll see. But, you know, Tesla, I can imagine is, up 3%. I mean, Tesla's got a lot of room up here before it's hitting any type of major longer-term resistance zone. You know, the 980s to the mid 1,000, you know, 1,050 or so. Here's my thesis on Tesla. You had your your bull flag breakout last week. To me, you know, I figured around 850, below 850 would invalidate this, but we're going straight up. First target's 950 to 975. Second target's 1075 to 1095. So, you know, Tesla's generally a pretty good indicator of, you know, risk on in the market, and you're seeing Tesla up almost 3.5% at this point. So,
yeah, I mean, and that's what with Tesla, like when we were going down in the markets, I kept looking at Tesla as a potential Okay, when we see Tesla, really break down and people are forced to sell, whatever, that could be the capitulation point on the bottom. And now it's like, now that we're going back up, it's like I expect Tesla to go, new all-time highs, like max stupid before there's another, any sort of downturn. It's just like this thing, it doesn't look like anything's going to slow it down. Like you said, there's not really anything above us to stop us right here, at least until we get into the thousands. Then you run into some resistance, but definitely a lot of people have been asking and watching Tesla over the past couple weeks.
Well, yeah, and I mean, here's a great example of declining volume and price rising. Look at Tesla. Tesla's big volume spike. Look at this. Here was your big kind of blow off top. There's your big volume spike. And then, oddly enough, we have COVID right after, so you have another big volume spike. That was your capitulation on the long side. And then look what happens pretty much from 2020 to now. Declining volume, literally since COVID low. However, we're up almost 1,200% on Tesla. You do not need increasing volume for a rally, in a big rally. So just want to point that out there, because there's so many people that think you need volume for a sustainable rally, and an increasing volume. That's just not true. One thing I'll say about Tesla is, if you look, this is the monthly chart. You do have this kind of ascending triangle that did break down on the monthly chart. We're simply just retesting this support zone, which would now act as potential resistance above. So that's something to consider on the bear thesis, but you go into the lower time frames and things are looking pretty strong. I mean, at least for me, I could see a retest of this symmetrical triangle resistance zone in around 1,000 to 1,050 before any type of meaningful pullback.
Yeah, 100%. No, like you. I mean, Jake, I'm bullish here till proven otherwise. Once once the rally starts breaking down, whether it's from a technical standpoint, or we start getting news headlines that indicate that maybe we should be moving lower. I don't know. I mean, I'm bullish till till proven otherwise.
Yeah, and I mean, a lot of people think that they can't change their thesis.
I know. I don't know why that is.
If something happens tomorrow that the market doesn't expect, I may change my whole thesis. Now it's going to be tough for me to change kind of the medium term bull thesis here over one day of price action. But if we start seeing some of these weekly candles breaking down below the previous lows that we've seen over the last couple of weeks, then I'll happily change my thesis. I'm not married to a bias. People who are married to their bias are the ones that get absolutely wrecked in the market. Speaking from experience in the past, I'm one of those people that have. And, you just cannot have, a lot of people think, well, I said that the market's going to keep going up, so I have to stick to it. No, smart people take new information in the market and then react to it and change their thesis. That's just part of the market. That's part of just how to be a flexible market participant and not get married to something. New information comes out all the time. You have to take that new information and you have to dissect it and see, does that change anything that was part of my thesis before. So
yeah, and I mean, and like you said earlier too, it also has to do with the ego part of it too. It's like the best traders, the best investors. It's not that they don't have losing trades. Of course they do. We all do. It's that they, aren't married to them and don't put their ego into it, so they can cut those losses without thinking it's some sort of like indictment as them as a trader that they had a losing trade. No, we're all gonna have losing trades. As soon as you can admit that and cut those, or change your thesis when you need to, the better off you're going to be, rather than holding on to it saying, no, I picked this stock, so I got to keep buying it for months and months and months, and it keeps going down. So, or whatever it is. So definitely, from what I've noticed, from what I've read about, all the best investors and traders try to, set aside that ego. And like you said, taking in new information as it comes, willing to change their thesis, not married to anything really.
Yeah. I mean, Paul Tudor Jones, arguably probably one of the best market participants, ever. I was reading the CMT book last year because I'm about to start studying for my CMT level 3. In the early 90s, I think he was like really bearish. I can't remember exactly what happened, but something about gold that he was really bearish or really bullish. Thesis changed, And, you know, if he would have held that same belief, he would have gotten wrecked. Instead, I think he ended the year like up 40% or something, because he was able to change his thesis, because he didn't care about being right. He cared about making money. And you know, that's a common theme across a lot of, you know, famous market participants, is they can, you know, they can fall on their sword and say, oh, I was wrong, but I'm going to change what I'm doing and adapt to what the market's showing me. So that's kind of where we're at you know, in the market right now. You've got a lot of people not doing that, and it's showing. And I mean, you go on Twitter, you post something, you know, I was even posting charts this week and making a couple posts where I'm like, it's hard for me to see the bear thesis here. People just like, oh, well, you know, what about record credit card debt? What does that have to do with the market? The economy is not the stock market, you know.
Yeah.
Unless that record credit card debt creates some massive liquidity crisis, some credit, you know, issue, systemic within, you know, the economy, maybe it matters, but who cares? I mean, that's not what price is telling me. So that's just kind of the way I look at it.
And if you look at a chart of credit card debt in the U.S. over time, I'm pretty sure it's just in a, like, you know, it's kind of going up, right? I know in 08, you know, whatever. So it's like, there's been multiple times where we've been, you know, a new all-time highs in credit card debt in the U.S. and that's not it hasn't been a bearish indicator. So I don't know why it would start being one now, or if it hasn't been, and it's just because that's what you know, sounds good right now. I don't know. But either way, Jake, I know we've had you on for a while, so I don't want to take up too much of your time today. We do have our next guest waiting in the background. Always a pleasure to get you on, man. Good to have you back after a couple weeks.
Yeah, absolutely. Looking forward to next week, and thanks for having me on. And we'll see what the market does.
Oh, Shelly's saying there's a credit issue in the chat. I don't know what that issue is. My credit card's working fine, or at least for now it is. I hope so. All right, Jake, we'll talk soon. I'm going to drop your Twitter in the chat so folks can follow you next Monday.
Awesome. All right. See you, man.
Peace. All right, guys, that was Jake Wujastyk from TrendSpider. I'm going to go ahead and drop his Twitter in the chat, as well as BZ25 is the TrendSpider code if you would like to go check out TrendSpider. Great software for checking charts. What you saw Jake doing there with the different, you know, volume profiles and whatnot. Really, TrendSpider, great place to be. Stonk squeeze. Rev looks ready to explode. More ads. No, yeah. So this was for me. I don't know. It was kind of a slow day in headlines. It was the top headline I had seen. So that's what I made the title. But basically, Apple, if you haven't seen, Tim Cook announced that they are going to explore putting more ads on your iPhone. So in terms of think about the Maps app that you might use for driving, you know, you've got your Apple Books app, you've got your Apple Podcast app, more ads on the apps on the iPhone, which should be a lot of money for Apple, right? We can pull up Apple stock and see how that's reacting. I'm going to go ahead and get my Benzinga Pro pulled up. I'm actually surprised, like I said earlier, not to see Apple stock up more, because you got to think about the magnitude of Apple's iPhone network. How many people, not just here in the US, but around the world, use an iPhone? So if they start throwing an ad for, you know, McDonald's $2 Big Macs on the Maps thing when you're looking for, you know, where to eat, like, I feel like companies are going to pay a lot of money for that. Where else are you going to get that many guaranteed users? Not on some, like, social media app, not on some whatever. It's like the Apple iPhone, to me, is a no-brainer for advertisers. And again, I'm surprised to see Apple stock not really moving up higher off of this, only up only up 0.6%. But maybe this is one of those things where analysts don't really know exactly how much money this could make, or what it's going to mean for the company, or what it's going to mean for revenue. And maybe down the road we start getting, you know, preliminary numbers saying, oh, actually, this is actually a really strong part of the business now. We're going to keep trying to grow this. Yeah, Apple Maps is kind of trash. I use Waze for the most part. All right, guys, I do see our next guest in the background hanging out. Let's go ahead and get him on. NewsByNick on Twitter aka Nicholas Brown. We go ahead and drop that Twitter in the chat so you guys can give him a follow. We'll see what Nick's been watching. What headlines Nick's been watching today. Mr. Nick, how you doing today?
I'm good. It's another Monday.
Yes, sir. Monday. That means the markets are back open. What have you been watching today?
So when you were chatting with your last guest, we got some few headlines that I thought that were worth attention here. Peloton says to retool their bikes for do-it-yourself assembly to cut costs. The CEO looks to launch rowing machine in time for the holidays. So that was just interesting.
Yeah. Okay. So what about were you watching the headlines that we got this morning, kind of before the market opened?
So I got up a little late, but I do know some of the headlines overnight were from some Chinese data that was very light. We got the Empire State Manufacturing, the New York Empire State Manufacturing here in the U.S. this morning. That was light. So it's been a pretty big day of, I think recession fears are back in some terms. We did with the housing market data. There were some terms that they used that could be the recession in the housing market. So that was very interesting. Not too much news for a Monday morning. I think it was very quiet coming out of the weekend into today, as we all await for Fed minutes on Wednesday and retail earnings from Target, Lowe's, and those companies like that as we head back to school. And so it's been a very light Monday, very light weekend. Overall.
Yeah. So wait. So you mentioned Target. Target gets ready to report this week, correct?
Either this week or next week. We have a lot of earnings between the next 2 weeks. It's going to be very hectic regarding not a lot, but regarding retail sales coming out. Retail sales this week. So not a lot of macro data too this week, but I think retail earnings this week and next week are really going to be on a lot of people's minds.
Yeah, I'm looking at our economic calendar right here. Looks like tomorrow morning before the market, we have building permits and housing start. So maybe if you're into the real estate markets or you're trading some housing names, maybe that's of interest to you. But then Wednesday, retail sales. We have retail sales excluding motor vehicles, real retail sales. So a bunch of retail Wednesday, and in addition, like you said, some different earnings. So there'll be some volatility in the retail names for sure. And then also, like you mentioned, FOMC minutes 2 p.m. on Wednesday, and then 2:30, Fed Governor Michelle Bowman speaks. Thursday before the market, initial jobless claims. And then we will have the Philadelphia Fed Manufacturing Index, which I assume the expectation will be pretty low after today's. And then, so that will pretty much round out the week in terms of economic data. So nothing, but maybe not the biggest week ever.
Right, but I mean, from the data we got today, it doesn't sound very good because the New York Empire Manufacturing came in at negative for August, negative 31.3. Estimate was for 5. Previous was 11.1. That's the second largest decline on record per Wells Fargo, and it's the weakest since May of 2020 per Bespoke Invest.
Yeah, which again, I mean, not news you want to hear. So we shall see what happens there. But like I was talking about with Jake, a lot of this may have been priced in as far as we know this quarter. And the next quarter, the past 2 quarters haven't been as good as ones in the past. Like I think a lot of investors out there have been pricing that in, saying, yeah, no, good job, Sherlock. Like the economy hasn't been amazing. Doesn't necessarily mean we're grinding to a halt and the market's gonna go to zero. But I think a lot of people thought that the manufacturing might be down.
Yeah, but I think another one to watch is the housing market because, housing, I mean, if you put your house up now, it's going to take, it's been months. I mean, there's a few in my area that's been listed since like last year for a few years now that really nobody's getting into. But I mean, the housing market, the index came in at 49. The estimate was for 54 and the previous was 55, sub 50 for the first time since May of 2020. And an interesting report on CNBC, the title is Home Builders Say the U.S. is in a housing recession as sentiment turns negative. I really think it comes to the NAHB chairman. He says the buyer's traffic number is at, quote, the lowest level since April of 2014, with the exception of the spring of 2020 when the pandemic first hit. He also says the bottom line here is tighter monetary policy from the Federal Reserve and persistently elevated construction costs have brought on a housing recession. Remember that housing all in is about 15 to 18% of the U.S. economy historically.
Yeah, and I'm seeing some people talking in the chat. Maybe saying the manufacturing number light isn't the best way to put it, but I mean, if you're a lot of people out there I'm seeing on Twitter and whatnot, like questioning today, I think that's your answer is that a lot of this has been priced in. So a lot of people wondering how could the market possibly be green right now, shaking their finger at their screen. It's like, look, hey, at the end of the day, markets, whether you think they're always efficient or always inefficient, like this is how they operate, right? Things that are coming out today may have been priced in months ago. People that are investing, people that are trading are trying to predict the future. They're trying to determine which industries are going to get hot, which industries are going to be lagging, right? So there's always an explanation, I feel like, for why the price action is doing what it's doing.
True. And now look, oil come crashing down today. I think WTI is near 88, Brent's near 92. So it's like the market will go up when oil is going down, but it's reversed whenever oil is green and the market is down normally. But no, I really think too, we're all watching signs of Germany because, there's speculation. There's more lawmakers over in Taiwan. We're trying to watch Putin of what he's going to do with the EU and with gas and oil. So there's still a lot of questions we have unanswered as we continue to head towards the winter season with gas, with oil, how prices are going to stabilize. I mean, this morning, Citi Research says their short-term price for ICE Brent crude is 85 to 80 in the coming weeks. So it needs to come down roughly between $8 to $10 from $8 to $10 a barrel from where it is right now. I mean, there's just a lot of questions that it's coming from overseas that we have because we really don't know what's going to happen. And I really think we're going to start to see some movement once we hear from Putin, once we hear what's happening with EU and gas, because there was a report out over the weekend from the FT that residents need to start saving at least like 15%. So we're going to have to really watch closely.
Yeah, and I mean, it's hard right now. I think I'm seeing comments in the chat too. MD saying housing market's just stabilizing. It's like, for me, it's weird because right now it seems like the market either has to, make new all-time highs or crash. The housing market either has to, crash or housing has to keep going up. It's like nothing can ever, I think to MD's point, the housing market might just be stabilizing. It might just, maybe we don't have to be all concerned and buy into all the sensationalism in the headlines and market crash this or, market crash that. It's like, maybe we're just going to trade sideways for a little bit. Maybe returns aren't going to be as great over the next year, but we're going to be okay. Like, no one's saying that. No one's saying, oh, maybe we're not going to make new all-time highs, but maybe we're not also going to crash and we're just going to hang out for a little bit. People know the economy might take a little bit of time to recover. We're still dealing with inflation. I feel like everything right now just has to be, you got to jump to this, big conclusion.
Yeah, and I think we're seeing that on a lot of things, even for earnings, whatever companies post better or do not beat expectations, they miss horribly, and all of a sudden the stock goes up. We always have a person defending why the stock is going up when really the stock should be going down. It was a bad report. If you really look internally, it's really not great. It happens on all fronts, and I really think too, data is like the center of everything. I think a lot of things, and look, I'm citing the data. A lot of people are citing the data. And I really think data, people are just like, yeah, data, whatever, it's okay. Where some, like me, you really look inside the data, and a lot of people really base off the data saying, hey, look, housing market recession. Oh, I think we got to go back to the recession camp. See, look, the tones have changed a little bit. When CPI came in Wednesday and Thursday, whenever we had the better than expected CPI report, everybody was backing off of the recession. You really didn't hear recession a lot on the street. Now today, when we got this data, recession fears are getting back into tune, and it's really like we're changing camps, we're changing the tone. Nobody really knows what's going to happen. Really, nobody knows what's going on. It all relates back to the crystal ball. Nobody has that crystal ball, and right in this time, we do need the crystal ball.
Yeah. Couldn't have said it better myself. I wish I had one. I'd be a lot wealthier. So let's just see him catching up on the chat, seeing if there are any other stocks people are watching, any trades. Looks like John Jacobs looking at BNGO. This is Bio Nano Genomics or something. Yeah, Bio Nano. Oh wow, I didn't know Bingo was getting a nice little squeeze there. I haven't really been watching this one for a while. I know this one got pumped all the way up to like $15 back in the day, but since then you've seen the stock crashing down. Nick, any other headlines you've been watching today or any stocks?
I really just think the meme traders are back in session. BBY, Bed Bath and Beyond, GameStop, AMC. We're seeing Wall Street Bet, Reddit getting back in from a summer vacation. They were like all out of the office, and all of a sudden we have these short squeezes coming up. But today is the last day for the hedge files for the filings for their quarter stuff. And some we got from Adage Capital Partners, some that caught my attention. I started to post a little bit on Twitter, but after a while I stopped. But a lot of these are pretty big, in my opinion. Adage Capital share, they cut share stake in JP Morgan to 1.86 million shares from 2.87 million. They raises the share stake in Gilead Sciences to 1.1 million shares from 191,977 shares. They raised their share stake in Lyft to 1.3 million Class A common stock from 500,000 Class A common stock. They raised the share stake in Uber to 818,408 shares from 276,408 shares. And they cut their share stake by 17.7% in Pfizer to 5.4 million shares and a SEC filing. Also, Twitter, they did a Twitter one too that was interesting. And that was, let me see here. I do have it on my screen. They raised their share stake in Twitter to 3.2 million shares from 835,000 shares.
Wow, that's significant. And you know, I don't know. I'm waiting on this. I want to see more. I want to hear more from this about the Twitter Elon deal. Have you got any updates on that?
No, we have not got any updates, and a couple people on Twitter were asking too if we got any updates. No updates as of yet. We haven't had any more Twitter news on a Friday evening, so we're going to be watching that closely as we get closer to the trial. I didn't see any articles out over the weekend regarding any new information regarding the Twitter Elon saga. So we're going to have to really watch those as we head into October. And I'm so lucky that the decision comes on Friday, the 21st, when I'm out of school very early on Friday. So I'll be able to cover that decision. But no, I really think too, to another point, Disney. I don't know. Did you hear about the Disney and Third Point's Dan Loeb in the company? There was a letter this morning.
I did see that Dan Loeb announced they were doing a new. Did they just make a new investment into Disney? I didn't really see the exact specifics of it.
Yeah, so they take a new stake in Disney, and some of the headlines from that is they plan to engage with the management and board. They do call for a refresh of the Disney board. Bloomberg out with a headline from that. They also urge Disney to pursue cost-cutting program, pay down debt, repurchase shares, reinvest in the business. And within a minute ago, we just got a new headline from Reuters. They're saying that Third Point holds roughly 1 billion stake in Walt Disney, owning 0.4% of the company's shares. Those are sources telling Reuters. But no, I think this is an emerging story because there was some talk. CNBC's David Faber was reporting that they could be Third Point wanted to have Disney acquire Comcast. There was some talk about that. So we're going to have to really watch this Disney Third Point's Dan Loeb and this new filing and this new what he's trying to do, what they're trying to do with the Disney board, how he says he wants to have a shakeup, refresh at the board. I really don't think so because I think Disney's doing all right. I mean, who knows what may happen if he acquires them or if they acquire Comcast. Because remember, we just learned from Disney CEO Bob Chapek. He was on CNBC and he didn't, sound any alarms that Disney was doing anything bad, that they needed help or anything. How he talked, he was very bullish, saying theme parks are coming back, streaming's phenomenally. So I really don't know what this was all about, but we're gonna have to really watch this because this was moving Disney shares Earlier, they were having their best days since April 21st, April 20th. That could change now as shares continue to move higher in the session.
Yeah, and I mean, Disney to me is one of those stocks, and here, let me get it pulled up on my Benzinga Pro. We got Twitter pulled up still. Disney was one that I was watching during kind of this COVID crash here in March 2020. Saw it get down to like 80, didn't buy it, watched it go from 80 to 200, thinking to myself, now why in the hell would I not buy Walt Disney stock, right? I know Disney's not going anywhere. It's one of those brand names. You can put it up there with Apple, with Nike, with Target, that you just know isn't going anywhere. And I didn't touch it. And then again, basically saw it get back down right to there. Didn't necessarily get quite as low as it did during COVID. Looks like we got to about 78 at our lows during COVID, got to 89, so about $10 more. But I didn't touch it down here again. And then now finally I'm looking at it saying, okay, I mean, if Dan Loeb and Third Point's interested in it, and then you've got some other buyers coming in, maybe it is time to start looking at a Disney position.
Yeah, and I mean, again, it all really depends too on fundamentals. I've been posting charts the past few weeks on Twitter in the evening, looking at the different stocks. I've done a lot, looking at the relatively moving average, 50, 100-day, 200-day, just to see where stocks are lying, because we're in this time where one day stocks could be above the 50-day, and then all of a sudden you look and they're below that, they're below the 200-day. And so there's a lot of bits and pieces in this market that we really have to look into. But I really think, to the Disney point here, that Disney should acquire Comcast. That come out of nowhere. I don't think anybody was expecting that from the letter. So we're really going to have to watch that, because, a lot of SPACs, IPOs, and acquiring things aren't really going. The Unity and the App11 deal, there was a solicited offer for that. They Unity CEO denied the offer. So that was earlier today too. So we're going to have to really watch how this plays out, what may happen.
Yeah. And in terms of other, I mean, I feel like for media companies, the landscape, you've had all these different mergers and acquisitions. You had, of course, AT&T with Warner Bros. And all this, but for the most part, for me, I mean, from what I've seen out of most of the media stocks, is like a lot of them I don't want to own. I feel like Disney is one of the few companies that I really wouldn't mind owning in the media space.
Oh no, a lot of these media stocks aren't going to go anywhere, because media and streaming continues to be strong, even though we're not seeing numbers back that we did in the pandemic when everybody was watching movies and stuff. When everybody was locked down, we're still seeing streaming. I mean, look, Netflix and Disney Plus overtaking Netflix, which was something interesting and wasn't expected until late 2024-ish. But I mean, a lot of these companies aren't really going anywhere. Netflix, I don't think anybody is really going to be saying, okay, I'm done with Netflix. I'm done with streaming completely. I don't think we should be owning Netflix. I really think Netflix, a lot of these streaming companies, Netflix, Roku, Hulu, Disney, a lot of these streaming companies aren't going to go anywhere.
Yeah, yeah, I agree. Netflix, though, to me, well, I mean, we've got Netflix pulled up right here. We're on a weekly chart. And it's so funny, like zoomed out on a weekly chart, it looks like we've barely made a move here at all. But really, I mean, it will go from a week to a daily chart. We've made some significant moves here from 170 in mid-June to 250 here now. I mean, that's, I don't know off the top of my head, I want to say 30% increase right now from the June lows, and you've got still a lot of room to run. So I do like Netflix down here. I think for a lot of people, you could argue, it's still expensive. And sure, I mean, it probably is by a lot of metrics, but it's still a growth stock. And if you're going to tell me that, Disney's has more subscribers, okay. That's fine. I don't think it has to be a scenario where Netflix has to be the leading streamer, or else you're not going to make money. I think there's a lot of scenarios where you invest in Netflix. It's a name, like you said, Nick, that's not going anywhere. People might, cancel their Netflix subscription for whatever reason. But for the most part, people that have Netflix are going to keep it. It's going to stay here. Just because Disney might have more subscribers doesn't mean that Netflix still also can't make a lot of money.
Right. I mean, there's just so many options that you go on the TV and look, you buy a Samsung TV, you get You can download Roku. You can download Netflix. You can download. So a lot of these streaming companies and streaming platforms are all intertwining together because look, I have a Roku TV right in my living room. And next thing you know, you get Comcast, then you can get Netflix, or if you have Roku, you can download other streaming partners. There's a lot of ways where you can acquire and get some of these streaming platforms, Netflix, Hulu, Roku. I mean, you just don't have to say, okay, I got to buy a Roku TV for me to get Roku. No, my grandma actually, believe it or not, has a Samsung TV, and it says you can go to the App Store and you can download Roku TV and you can download Netflix. So you're intertwining a lot of these. I don't know why some people say I have to buy a Roku TV so I can watch Roku things and just watch specific things on there. No, you can literally mix and match.
Yeah. And I see someone in the chat saying a growth stock that's not growing. So I know Netflix, and that was obviously what, why we'll go back to the weekly chart here. Part of the reason why it came down 75% is because they announced that, for the first time ever, they lost subs over a quarter, or maybe they just stopped growing. So you got to think, I mean, streaming as an industry as a whole, right? And you got to think, we're not just talking about the US here. We're talking about around the globe, right? It's kind of like video games. It's still a growing industry. It's still going to grow. What we saw during COVID was you saw a lot of this growth pulled forward, happen very quickly, to now to the point where I think, to the commenter's point, you're seeing some of this growth, come down, or you're seeing, essentially the opposite of growth. That doesn't mean the industry isn't still going to grow. And I mean, pulling up Netflix's income statement, they're still growing revenue. I mean, look, they did 7,000, almost 8,000, almost 8 billion revenue versus 7.8. So they still made more money, and that's the bottom line. I mean, it depends. If you like Netflix's stock here, it depends on if you think the company is going to grow from here on out. If you think the company's done growing, then this is the easiest short in the world, and it's $250, and the company you think it's priced as a growth stock. Right, we can go to our overview here. It's still, forward PE 25, price to sales 3.5. That's above S&P average. It's not a crazy high valuation, but it's still being priced that it's going to grow. So if you think it's not going to grow, then it's the easiest short ever. If you think, okay, it grew a lot during COVID, a lot of that growth was pulled forward, now we're regressing to the mean, but this is still a growing industry, and you still expect to see growth. That's more where I land on it. I wouldn't be surprised to see Netflix's stock come down from here a little bit more, but I think that these I would be surprised to see Netflix not grow over the next 10 years or so. And who knows? Maybe it's some innovation that we haven't seen from them yet. Maybe it's on sports. Maybe it's on video games. But who knows?
Well, yeah, to the point though, remember a lot of these companies have pulled out of Russia. Netflix, a lot of these streaming companies pulled out of Russia whenever they invaded Ukraine. And so remember, Russia has some subscribers. So maybe, once they get back into the swing of things, and who knows, some of these companies may go back to Russia. Who knows? We haven't really gotten a definite answer. They could be acquiring more streaming people, and revenues could be going up, and it could be growing once again. It's all a matter of time to really see. I mean, look, we just got last week McDonald's. They're going to open back up in Ukraine. They're going to try and get in Kiev. They're going to try and get the services back up. So we're going to have to watch that play out. But really, to the point here, at one point, you're just going to have to say, okay, we have to give up on this war. I mean, the war just can't go on forever. And so maybe these streaming companies and whoever, I mean, there was tons of companies and tons that pulled out of Russia. Maybe eventually, once things settle down, they simmer down. Maybe these companies will go back in, and some of these streaming platforms and other platforms will gain subscribers.
Yeah, I mean, and that's where I think my point was more with Netflix. With I don't think it really has to be a scenario where you have to pick one or the other. Like, it can be something where it's like a rising tide lifts all ships. So to see Disney's growth doesn't really deter me as a Netflix investor. Like, I hold Netflix shares in my long-term account, and added some. Well, I didn't have any, but I started adding some, like, I don't know, sometime down. I'm still underwater on them right now. Actually, maybe not even anymore. I have to check. But either way, like, that doesn't bother me. Like, I'm invested because for the company, but also for the industry. Like, seeing streaming growing is like, that's a good sign, and I expect that to happen again, not just here in the U.S. but throughout the world. So, Who knows? Yeah, I mean, I could be wrong about Netflix, but I feel good about buying a name like Netflix at such a discount. I mean, you're talking about, we were down 75% from our highs.
I mean, a lot of people, they just don't have one streaming platform, Disney Plus. They have a wide variety. Disney Plus, Roku, Hulu, Netflix. I mean, at one point, you just have to say to yourself, let's just pick one and stay because, I mean, prices are going up. And we've seen that with Netflix, that they're going to have to raise the prices. But I mean, I think a lot of people are that diversified. They have a lot of streaming platforms because there's a lot of shows that maybe are on Netflix that maybe aren't on Roku or aren't on Hulu or aren't on Disney Plus or aren't on Disney. So there's a lot of pros and cons to just having one and all. So a lot of people own a lot of, they buy the different ones because each streaming platform is its each and own business, and there's different perks for each.
100%. I know most people have, the different ones. I think Netflix is one though that people to me, and who knows, like, could be completely wrong, and Netflix could be in real time, like as we know it, losing their cultural importance and impact. But I think Netflix has like gotten to a point where they're good for like 2 series or movies a year that people like really, whether it's Squid Game, whether it's Stranger Things, and it's like until that's not there, until if we go a prolonged period of time, like a year, and obviously Squid Game, Stranger Things hasn't helped their business that much. Well, actually, I think it has helped their business a lot because you probably see their subs dropped off a lot more had it not been for like those 2 names, Ozark's other names. But if we go a prolonged period of time and we don't get, any of those like culturally important shows where people are talking about them, then sure, then the whole Netflix thesis goes out the window. But as far as I'm concerned, streaming is going to keep growing. Netflix is going to continue to be a leader in the space. Does that, again, I still think it could be overvalued here, 100%. But, yeah, and NDO saying they're spending too much to acquire content. They probably got to figure out a feasible business model, but who knows?
No, who knows with some of these streaming companies? I mean, I don't think streaming is going anywhere. I don't think it's going to die down. I think as we get more people into the generation, more generations continue to come upon us, more people are going to continue to subscribe to these areas because they like the shows. Now, personally, I mean, we have Netflix.
Yeah, what do you have? You have Netflix?
So we have Netflix. I really don't watch a lot of Netflix. I really don't watch a lot of streaming platforms, but my family does. They're interested in the history, and so I mean, I am too. But I'll pop in here and there. But I mean, I have my own account on Netflix. I search around eventually here and there, but I'm not a person that is sitting right in front and streaming. I mean, look, I pick sometimes up my phone and just start watching streaming stuff on my phone. I mean, at this point, you can basically watch streaming anywhere, phone, computer, TV. But we have Comcast, so you have Peacock, then you get the Netflix. We have Roku, so you get the different perks. I mean, we have a lot of streaming services that we use. I don't personally use it, but I mean, we have them because they're perks, and if you buy this package, you get this. They sucker you in whenever you buy this package, Aaron. You also get this, and so I'm like, okay, well, I don't want this, so you have to buy this package for that. I mean,
that's just being
right.
Yep. That's how being a consumer is in 2022. All right, Nick. Well, it is 12:56. Only got a few minutes left. I'm gonna go ahead and drop your Twitter in the chat so folks can go ahead and give you a follow. Again, that's news_by_Nick. Yep, there it is. And I'm dropping that in the chat. Nick, always a pleasure to get you on. We'll find you another day this week to have you back on the show. I know you're getting ready to start school soon, so got to get as much Nick on Benzinga Live as we can.
Yes, I tweeted over the weekend. I just realized this was my last full week of vacation, and it's like summer's coming to an end already. Like this is like ridiculous. But no, I'll be on through school Fridays. Real probably tight at the end, but anything is possible. I'm excited for school this year, taking a new elective, Fundamentals of Journalism. So
there you go.
I'm excited for that one this year, and a lot of others. But no,
hopefully,
this has been a great summer, great joining you, and I'm not going away. Just because school's starting, that does not mean I'm going away. I'm not going to be back on.
Yeah, hopefully your principal journalism teacher never tried to blow up a football field.
I'll have to ask, and we'll see how far that goes.
Yeah, let me know. All right, Nick, enjoy the rest of your day. We'll talk soon.
Thank you. You too.
All right, guys, we've only got a few minutes left, but maybe a new segment alert. I had an idea for maybe, because I was seeing some different ideas of how to make some money over the weekend, like make some quick money. That could be a good segment idea. Like if you had some bad options trades and you needed to make a few bucks, some different side hustles. So like AB's side hustle of the day. My first one that we found, you guys may have seen this over the weekend. I think it was making its round around FinTwit, but this is just so genius to me. I legitimately think if you do this around the right college campus, you could make 6 figures. If not 6 figures, like an easy, like cool 50 racks a year. All right, fake tutor. Let your parents pay you. How it works. You convince your parents, grandparents, whoever that you need professional tutoring. Make sure it's a course that you find rather easy but could ascertain a high dollar rate per hour. We pretend to meet X days a week at X dollars an hour. They pay me digitally or by check, and I give you 70% of whatever they pay to you in cash. We both profit. You now have way more spending money while appearing as a diligent student. It's a win-win. Who am I? I'm a 27-year-old well-educated dude who formerly worked at SSNC, Goldman Sachs, and a hedge fund. Right now, I'm writing a novel and working on way less shiesty business. That will be my real career. This scheme is 100% for easy money as I need funds for my real goal, but this kind of sounded fun and practical around Yale. So he's in Yale, which is, I don't even know where, Connecticut somewhere in the Northeast. What do you learn? Not much, but your bank account likes to learn, or learns to like me. Maybe you'll learn how to snorkel on all the extra vacations you can afford now. Contact Ivy Tower Tutors. So he even like made up a fake name. Extra details. This would be hilarious to scale up. I'm open to inquiries on that as well. I enjoy schemes, abstract method, business methodologies, and making money. Okay, so if you're gonna try to come up with some sort of scheme, some sort of way to make money, to this person's credit, pick a good target, right? They're picking rich parents that are sending their kids to Ivy Leagues. And I know not every single kid at an Ivy League is rich, but I guarantee you, it's not going to be the kid that's on, I don't even know what's it called. Financial aid. It's not going to be a kid that's on financial aid that's asking their parents for $100 an hour for a calculus tutor. It's going to be that kid from Greenwich, Connecticut that can afford it. So, hey, if you're going to try to find a scheme, this one up there, I don't mind it. I don't mind it. All right, though, folks. That will be a wrap for us today. I don't think the selling feats works if you're a dude, but who knows? If I'm wrong, someone's to let me know. Let me know. All right. That'll be a wrap for us today. We will be back tomorrow, 11:30 a.m. Eastern. Till then, love you guys. Smash the like, subscribe to the channel if you have not already. Money Mitch got a couple good interviews coming. Oh, whoa. We've got photo bombers. Money Mitch will be talking to Tom Siodamas, the CIO at AE Wealth Management, as well as Pedro Palandrami from Global Research at Global X ETFs. Have a good one, boys and girls. Till tomorrow. Peace.